Hello everyone, welcome to the 201st episode of me learning how to trade in Forex. So in the last episode we finished off this page on how to trade Forex. I think in the previous episode we started going through this and we've finished off at about up to this bit here, so understanding the basics. So yeah, basically USD JPY, first base, second quote currency. How much of JPY is needed to buy 1 USD? So in this case 134.82. JPY is needed to buy 1 USD. Transacting in the most common currency pairs is typically very easy because these markets are very liquid and have very narrow bid offer spreads. PIP is the smallest increment a market trades in, typically 0.0001. However, it's 0.01 for USD JPY. So base currency, quote currency, yep. Using leverage for CFDs, which is contract for differences. And then options for trading Forex, so trading directly for bank or financial services provider, trading currencies future listed on exchanges through a commodity trading account, and opening an account with a foreign exchange broker that essentially provides individual trader with access to the interbank market through its own platform. So understand the risk of trading Forex. Forex trading can be volatile as markets can adjust very quickly to new information and news. While this is similar to many other markets, the market participants in Forex also include central banks, with the largest banks making a large share of the markets. Prices can fluctuate greatly during the day, so retail Forex traders are small fish in a large ocean. Leverage, significantly greater than stocks for currency trading, so some brokers offer up to 50 to 1 leverage on more liquid currency pairs. So leverage presents greater profitability to traders, but that opportunity also involves commensurate risk on losses. Types of Forex markets, spot, forward and futures. Spot Forex market, outright exchange of one currency for another at the time of the trade for a specific exchange rate. Spot FX trades typically settle with the actual exchange of currencies at the rate traded 2 days after the trade. So some exceptions to the spot plus 2 day settlement. So USD CAD, which settles 1 day after the trade date. And then we got the forward Forex market, so contract between two parties to exchange a set amount of one currency for a set amount of another currency on a specific date in the future. Difference from in the future FX rate from the current spot rate is a function of interest rate differentials. So the specifics of forward Forex trading are not standardized, which means market provides users with the flexibility to hedge specific risk amounts over specific days. And then counterparty trying to set a fair currency rate for the future will use the current spot exchange rate, then adjust it based on interest rate differentials for the time period of the transaction. And then we got the futures Forex market, so there's also exchange traded futures contracts, which are similar to forward foreign exchange, but fixed contract terms and trade on regulated futures exchanges. So while these markets are standardized, they do not allow users to hedge specific date risks or amounts, all of which is possible in the forward Forex market. So some factors to consider when opening a Forex account. Fees, brokerage fees for foreign exchange trading are generally very reasonable. Two primary payment methods. One is to pay brokerage on trades, which usually works as a rate on the notional amount traded and are tiered lower for higher trading volumes. Other method is no brokerage fee but wider bid-ask spreads that prices the broker's fees into the trading price. Account minimums can start with any amount of money, and funding requirements can be as low as $100, but you'll want more than that in the account to really begin trading. Number and quality of supported markets. So some brokers support up to, I guess, up to 200 currency pairs, but there's a great difference in liquidity in the various markets. So 7 most actively traded currency pairs represent 75% of all FX trading. Once you go beyond these, there's a wide difference in liquidity. There would be available market for less active currency pairs, but the spreads would be much wider and there will not be nearly as much liquidity in the markets. Research tools. So research tools such as the quality of technical analysis and fundamental news are important factors for an FX trader. How fast these tools populate data becomes very important for trading fast moving currency markets. So whether these tools integrate smoothly into the trading platform can make a difference in the trading experience. So on. Demo accounts. So demo accounts, great way to become familiar with trading a particular market on a broker's platform. So new traders should choose a broker with demo trading so they can learn how to place orders and manage positions effectively without having to commit real capital first. So demo accounts allow users to become comfortable with the platform and its various tools prior to trading for their own accounts. Then we've got customer service. So newer customers may want to consider the quality of customer service offered by the broker. So some customer service are quicker to respond than others, and some brokers might also have automated assistance and chat functionality to assist the customers. So is trading Forex difficult? Yeah, it has its pros and cons, so using leverage and stuff like that. So take appropriately sized positions and employ disciplined risk management techniques with stop losses. So how much cash do you need to start trading? Keep your risk consistent regardless of your capital level. So trading with a smaller stake means getting a bad fill on a stop loss when a fast moving market shoots through your stop level could result in an outsized loss of capital. So very little room for error with a small amount of capital. So trading accounts should be used in fast moving markets like foreign exchange, should account for some margin of error and the unexpected. I remember them also saying there's like only risk 1% of your total account per trade. So yeah. Can you cash out on your Forex account? Yep. So liquidate your trading position, wait for settlement and transfer the funds out of the account. Who trades Forex? Retail traders, large investment banks, regional banks, private wealth management firms, corporations and so on. Governments. La-di-da-di-da. So large international banks that make up the interbank market. Can you lose money while trading Forex? Yes, you can. So risk management is critical in Forex markets. And that's everything. So finish this one off. Can close that tab. Still got some tabs open. So I think this tab is the strategy and education. So how trading in the foreign exchange market works. Which is this article, I think. No, it is not. I think the thing with this Investopedia page is that there's so many stuff to go through that it's not really like organized properly, so I guess they're all strategy and education, but there's no like beginner, intermediate, advanced like levels to this, it's just what is a currency board, like what? Investopedia. Forex, FX, how trading in the foreign exchange market works. Date is the 19th. Right, so what is the Forex or FX? The foreign exchange market, commonly referred to as Forex or FX, is a global marketplace for the trading of one nation's currency for another. So I think now any of the repeated stuff that I already know, I'm not going to write them down anymore because there's just no point. So they're all going to get deleted later on anyway. So already know that the Forex market is the largest, most liquid market in the world, with trillions of dollars changing hands every day. Has no centralized location and no government authority oversees it. Rather, the Forex is an electronic network of banks, brokerages, institutional investors, and individual traders, mostly trading through brokerage or banks. Key takeaways. The Forex is a global marketplace for exchanging national currencies. Foreign exchange venues comprise the largest securities market in the world by nominal value, with trillions of dollars changing hands each day. Foreign exchange trading uses currency pairs, priced in terms of one versus the other. Forwards and futures are another way to participate in the Forex market. Foreign exchange, Forex or FX. Foreign exchange, Forex or FX is the trading one currency for another. Understanding the Forex. The Forex market determines the day-to-day value or the exchange rate of most of the world's currencies. If a traveller exchanges dollars for euros at an exchange kiosk or a bank, the number of euros will be based on the current Forex rate. If imported French cheese suddenly costs more at the grocery, it may well mean that the euros have increased in value against the US dollar in Forex trading. So if it costs more at grocery, then that means the supermarket has to buy the cheese at a higher price than it used to. So therefore it has to sell at a higher price to make a profit. So if it bought it at a higher price than it used to, then so for example, if the cheese used to cost $10 to buy back in the day, now it takes 15. That means the euro has strengthened against the USD because it will take more USD to get that 1 euro. So euros have increased in value against the USD. Yep. In Forex trading. Forex traders seek to profit from the continual fluctuations of currency values. For example, a trader may anticipate that the British pound will strengthen in value. The trader will exchange US dollars for British pounds. If the pound then strengthens, the trader can do the transaction reverse, getting more dollars for pounds. Currency pairs. In Forex trading, currencies are listed in pairs such as USD CAD, EUR USD, or USD JPY. These represent the USD versus the CAD, the Euro versus the USD, and the USD versus the JPY. There will also be a price associated with each pair, such as 1.2569. If this is the USD CAD pair, it means that it costs 1.2569 CAD to buy 1 USD. If the price increases to 1.3336, then it now costs 1.3336 CAD to buy 1 USD. The USD has increased in value against the CAD, so it now costs more CAD to buy 1 USD. In the Forex market, currencies trade in lots called micro, mini, and standard lots. In the Forex market, currencies are traded in lots. So a micro lot is 1,000 worth of a given currency. Micro lot is 1,000 of a given currency. Mini lot equals 10,000 of a given currency. Standard lot equals 100,000, right? It's 100,000 of a given currency. So micro is 1,000, mini is 10,000, and the standard is 100,000. Trades take place in set blocks of currency. For example, a trader can exchange 7 micro lots, 3 mini lots, or 75 standard lots. That's huge. Trading volume in the Forex market is generally very large. Trading in the foreign exchange markets averaged $7.5 trillion worth per day in April 2022, according to the Bank for International Settlements. The largest trading centres are London, New York, Singapore, Hong Kong and Tokyo. Trading in the foreign exchange markets. The Forex market is open 24 hours a day, 5 days a week around the globe. Historically, foreign exchange market participation was for governments, large companies and hedge funds. In today's world, trading currencies is as easy as a click of a mouse and accessibility is not an issue. Many investment companies allow individuals to open accounts and trade currencies through their platforms. This is not like a trip to a foreign exchange kiosk. The process is entirely electronic, no physical exchange of money from one hand to another. Rather, traders are taking a position in a specific currency in the hope that there will be some upward movement and strength in the currency that they're buying, or weakness if they're selling, so that they can make a profit. Forex market versus other markets. There are some fundamental differences between foreign exchange and other markets. First of all, there are fewer rules, which means investors aren't held to strict standards or regulations like those in the stock, futures and options markets. There are no clearing houses and no central bodies that oversee the forex market. Second, since trades don't take place in traditional exchange, there are fewer fees or commissions like those on other markets. Next, there's no cut-off to as when you can and cannot trade, because the market is open 24 hours a day. You can trade at any time. Finally, because it's such a liquid market, you can get in and out whenever you want. You can buy as much currency as you can afford. No central bodies which oversees the forex market. Types of forex transactions. Forex traders transact in one of three distinct marketplaces: the spot, the forward or the futures market. To find the best entry and exit point for a trade, they will use a variety of analysis techniques. So the Forex spot market. The spot market is the most straightforward of the Forex markets. The spot rate is the current exchange rate. A transaction in the spot market is an agreement to trade one currency for another currency at the prevailing spot rate. Spot transactions for most currencies are finalized in 2 business days. The major exception is the USD versus the CAD, which settles on the next business day. The price is established on the trade date, but the money exchanged on the value date. The price is established on the trade date, but the money exchanged on the value date. For spot transactions, the price is established on the trade date, but the money is exchanged on the value date. Role of the USD. The USD is the most actively traded currency. The most common pairs are the USD versus the Euro, JPY, British Pound and the Australian Dollar. Trading pairs that do not include the dollar are referred to as the crosses. The most common crosses are the Euro versus the Pound and the Euro versus the Yen. The spot market can be very volatile. Movement in the short term is dominated by technical trading, which bases trading decisions on a currency's direction and speed of movement. Long-term changes in the currency's value are driven by fundamental factors such as the nation's interest rates and economic growth. Okay. The Forex forward market. A forward trade is any trade that settles further into the future than a spot transaction. The forward price is a combination of the spot rate plus or minus forward points that represent the interest rate differential between the two currencies. The forward price is a combination of the spot rate plus or minus forward points which represent the interest rate differentials between the two currencies. Most forward trades have a maturity of less than a year in the future, but a longer term is possible. As in the spot market, the price is set on the transaction date, but money exchanged on the maturity date. So like 2 days later, probably. A forward contract is tailor-made to the requirements of the counterparties. They can be for any amount and settle on any date that is not a weekend or holiday in one of the countries. A forward contract is a tailor-made to the requirements of the counterparties, which can be for any amount and settled on a date that is not a weekend or holiday in one of the countries. Forex futures. Unlike the rest of the foreign exchange market, Forex futures are traded on an established exchange, primarily the Chicago Mercantile Exchange. Forex futures are derivative product contracts in which a buyer and a seller agree to transaction at a set date and price. Forex futures are derivative contracts which a buyer or seller and a seller agreed to a transaction transaction at a set date and price. This type of transaction is often used by companies that do much of their business abroad and therefore want to hedge against a severe hit from currency fluctuations. It is also subject to speculative trading. Example of a forex trade. A trader thinks that the European Central Bank will be easy in its monetary policy in the coming months as the Eurozone's economy slows. As a result, the trader bets that the euro will fall against USD and sells short 100,000 euros at exchange rate of 1.15. Over the next several weeks, the ECB, the European Central Bank, signals that it may indeed ease its monetary policy. That causes the exchange rate for the euro to fall to 1.1 versus the dollar. This creates a profit for the trader of 5,000. By shorting 100,000 euro, the trader took in 115,000 for the short sale. When the euro fell, the trader covered the short. When the euro fell and the trader covered the short, it cost the trader only 110,000 to repurchase the currency. Difference between the money received on the short sale and the buy to cover it is the profits. Had the euro strengthened versus the dollar, it would have resulted in a loss. So pros and cons of Forex. Pros. The Forex was once the exclusive province of banks and other financial institutions. The internet has blasted the doors wide open. Entry costs are low and the marketplace is open around the clock. There are many choices of Forex trading platforms, including some that cater to beginners. There are also online Forex trading courses that teach the basics. Ooh, you know what? This is kind of interesting. Best online Forex trading classes. Cons. Those financial institutions and the traders who work for them are still there. Alongside the neophytes working from home. They have deep pockets, sophisticated software that tracks currency price movements, and teams of analysts to examine the economic factors that make currency rates move. Currency trading is a fast-moving, volatile arena. quickly impacted by changes in global events. It is a risky business and can be made riskier by the use of leverage to increase the size of lots. It's an easy way to lose money fast. Anyone willing to jump into Forex should get the necessary training in advance and start slowly with a minimal stake. Pros and cons of Forex. Pros: accessible to individual investors through online trading platforms, open 24 hours a day worldwide, relatively light regulation or oversight. Cons: dominated by professionals and institutions with deep pockets, volatile prices subject to sudden swings based on news, relatively steep learning curve for newcomers. Forex terms. There are a number of terms that are used by Forex traders. Here are some of the basics. Going long, buying a currency on the belief that its value will increase in a matter of hours, then it can be sold for a profit. Going short, selling a currency on the belief that its value will decrease, it can then be purchased at a lower price. Currency pair. Every Forex transaction is an exchange of one currency for another. Currency pair quote looks like this: USD/GBP equals $1.15. Shouldn't it be 1.15 pounds? In this example, the USD is a base currency and the British pound is a quote currency. Trader who wishes to buy British pounds will pay $1.15 for each. Wait, that's wrong, isn't it? Shouldn't it be pound sign instead of the dollar sign? So USD GBP equals 1.15 pounds because it costs 1.15 pounds to buy 1 USD. So how come a trader who wishes to buy British pounds will pay $1.15 for each? Huh? A trader who wishes to buy British pounds will pay 1.15 for each. No, that's wrong, isn't it? Will pay $1.15 for each pound. Well then surely GBP should be at the front if it's $1.15. Nah, that doesn't look right. So the ask, the price the trader will pay to buy a currency pair. The bid, the price the trader will pay to sell a currency pair. Spread, the difference between the buying price and the selling price. So sell, bid, ask, buy. Major currency codes in the Forex. On the Forex. Just 7 currency pairs represent the majority of trades on the Forex. They are Euro USD, Euro USD, USD JPY, GBP USD, AUD USD, USD CAD, USD CHF, NZD USD. So I think these are the 7 most popular pairs that make up for, was it like they said it was 75% of all Forex trading activities. So how big is the Forex market? The daily trading volume on the Forex market dwarfs that of the stock and the bond markets. According to the latest triennial survey conducted by the Bank for International Settlements, trading in the foreign exchange markets averaged $7.5 trillion per day in April 2022. By contrast, the notional value of the US equity markets on December 31st, 2021 was approximately $393 billion. What is foreign exchange trading? When you're making trades in the foreign Forex market, you're buying the currency of one nation and simultaneously selling the currency of another nation. There's no physical exchange of money. Traders are taking a position in a specific currency with the hope that it will gain in value relative to another currency. How does the Forex market differ from other markets? The Forex is a decentralized market. It has no physical existence and no owner or management. There are no clearing houses or central bodies to oversee the Forex. That means traders aren't held to strict standards or regulations, as are seen in the stock, futures or options markets. It also means there are fewer fees and commissions to pay. So the bottom line. The Forex or FX is a global marketplace for the exchange of currencies. As such, it determines the value of one currency against another in the real world. Forex price determines the amount of money a traveller gets when exchanging one currency for another. Forex prices also influence global trade, as companies buying or selling across borders must take currency fluctuations into account when determining their costs. Forex prices influence global trade as companies buying or selling across borders must take currency fluctuations into account when determining their costs. Inevitably, the Forex has an impact on consumer prices as global exchange rates increase or lower the prices of imported components. So, Forex impacts consumer prices as global exchange rates increase or lower the prices of imported products. So that's the first article done of the Forex trading strategies and education. On to the next one, which is Forex trading, a beginner's guide. Next up. How to start Forex trading, a beginner's guide. So foreign exchange, Forex or FX trading involves buying one currency and selling another while attempting to profit from the trades. According to the latest reliable data from 2022, global daily trading was to $7.5 trillion, making Forex trading the largest financial market in the world, dwarfing even the global stock market. Trading currencies online has become far more accessible in the last decade, attracting droves of new traders wanting a piece of the action. In the Forex markets, currencies trade against each other exchange rate pairs. For example, the Euro USD will be a currency pair for trading the Euro against the US dollar. This is straightforward, but the market lingo comes fast at beginners and can quickly become overwhelming. Assets traded in FX include currencies, contract for differences, indexes, commodities, spreads, and cryptocurrencies. There are also Forex spot and derivative markets for forwards, futures, options, and currency swaps, all to speculate or hedge on Forex prices. If all this weren't enough, jargons like pips, lots, and leverage mean that without good introduction, newer traders can quickly feel they're in over their heads. That's why we've put together this detailed guide to getting you started trading foreign currencies the right way. We'll break down the essential concepts and guide you through the most critical steps, from choosing a broker and placing your first trade to developing a solid strategy and, most importantly, managing your risk. So key takeaways. The foreign exchange, Forex or FX market is a global marketplace for exchanging national currencies. Because of the worldwide reach of the trade, commerce and finance, Forex markets combine to be the world's largest and most liquid asset markets. Currencies trade against each other as foreign exchange rate pairs. For example, Euro USD is a currency pair for trading the Euro against the US dollar. Forex markets exist as spot, cash and derivative markets, offering forwards, futures, options and currency swaps. Some market participants use Forex to hedge against international currency and interest rate risk, speculate on geopolitical events and diversify portfolios, among other reasons. What is the Forex market? The foreign exchange market is where currencies are traded. Its most striking aspect is how it has no central marketplace. Instead, currency trading is done electronically over the counter. All transactions occur via computer networks among traders worldwide. The main markets are open 24 hours a day, 5 days a week. Currencies are traded worldwide, but a lot of action happens in the major financial centers such as Frankfurt, Hong Kong, London, New York, Paris, Singapore, Sydney, Tokyo and Zurich. This means the Forex market begins in Tokyo and Hong Kong when the US trading day ends. The Forex market is highly dynamic at all times, with price quotes changing constantly. Tip: you often see the terms FX, Forex, foreign exchange market and currency market. These terms are synonymous and all refer to the Forex market. So all mean the same thing. How does the Forex market work? The FX market is the only truly continuous 24 hours a day during weekdays trading market in the world. In the past, the Forex market was dominated by institutional firms and large banks, which acted on behalf of clients, but it has become more retail oriented in the recent years. Traders and investors of all sizes participate in it. There's a caveat to this: newer traders in the market have helped lure in fraudsters looking to take advantage of less knowledgeable investors. Where is it? Interesting aspect of the world Forex market is that no physical buildings act as trading venues. Instead, there are a series of connecting trading terminals and computer networks. Market participants are institutions, investment banks, commercial banks, and retail investors worldwide. Who trades on it? Currency trading was complicated for individual investors until it made its way onto the internet. Most currency traders were large multinational corporations, hedge funds, or high net worth individuals because Forex trading requires a lot of capital. Commercial investment banks still conduct most of the trading in Forex markets on behalf of their clients. However, there are also prospects for professional and individual investors to trade one currency against another. So the dramatic rise of Forex trading, FX market turnover by instrument trillions. FX swaps, spot transactions, outright forwards, currency swaps, other. Cool. So what is Forex trading? At its core, Forex trading is about capturing the changing values of pairs of currencies. For example, think the euro increase in value against USD, a speculator might buy euros of dollars. If the euro's value rises on a relative basis, the euro USD rate, you can sell euros back for more dollars than initially spent, thus making a profit. In addition to speculative trading, Forex trading is also used for hedging purposes. Individuals and businesses use Forex trading to protect themselves from unfavorable currency movements. For example, a company doing business in another country might use Forex trading to insure against potential losses caused by fluctuations in exchange rates. By securing a favorable rate in advance through Forex trades, a firm can reduce financial uncertainty and ensure more stable costs in its domestic currency. This is an essential part of international business today. By securing a favorable rate in advance through Forex trades, a firm can reduce financial uncertainty and ensure more stable costs in its domestic currency. Forex trading has high liquidity, meaning it's easy to buy and sell many currencies without significantly changing their value. In addition, traders can use leverage to amplify the power of their trades, controlling a significant position with relatively small amounts of money. However, leverage can also amplify losses, making Forex trading a field that requires knowledge, strategy, and awareness of the risks involved. Forex trading is also quintessentially global, encompassing financial centers worldwide. This means that currency values are influenced by a variety of international events. Economic indicators such as interest rates, inflation, geopolitical stability, and economic growth can significantly impact currency prices. Currency values are influenced by a variety of international events such as interest rates, inflation, geopolitical stability, and economic growth can significantly impact currency prices. For instance, if a country's central bank raises its interest rates, its currency might rise in value due to the higher returns on investments made in that currency. Similarly, political uncertainty or poor economic growth outlook can depreciate a currency. These interlocking exchange relations, some currencies growing stronger, others not, means Forex trading reflects worldwide economic and political developments. Most traded currencies, percentage of transactions on one side of an exchange, 2022. US dollar 88%, other currencies 41, Euro 31, JPY 17, British pound sterling 13, Chinese yuan 7%. Cool. So I'm going to leave this episode here then. Yeah, in the next episode then we're going to carry on from here with how to start trading Forex. So thank you all for watching. Peace.